is in the building. Facto.
Welcome to Ignorance is Contagious, a podcast about stories and the life lessons you learn from them. I'm James LeGrand.
And I'm Abdul Majid.
In today's episode, we'll be discussing the GameStop short squeeze saga and try to figure out, is greed good? Here back with us to give us her perspective is the lover of all things funny, Kristen J. Thank you for coming back to the podcast.
Hi. Thank you so much for having me back.
No problem. Thank you for showing up. So the reason I picked this particular story is because it felt like a very American story with regards to capitalism and money. And a while ago, I was reading this book by Karl Marx called Das Kapital. And it just explains the idea of capitalism and its critiques on capitalism. In this particular story, you have the aristocrats in Karl Marx's theory, which is the ruling class. You have the middle class, which he refers to as the bourgeoisie, the merchant class. And then you have the working class, which is referred to as the proletariats. So you have these intersecting groups of these three particular parties fighting for money and power within this capitalistic system. And I thought it was laid out with regards to Twitter, how Twitter became a big part of the story. And the like in every good story, I always hone in on the vicissitudes of most stories, and the ups and downs of the story made it really intriguing.
So to our listeners, please keep in mind that we cannot and will not give any investment advice. This podcast is for entertainment purposes only. We will be giving our opinions on a number of things, and we may be talking about specific investment strategies that we've individually followed, but that should not constitute and does not constitute any type of investment advice. So now that we got the legal mumbo jumbo out of the way, Kristen J, take it away.
I will be reading an article written by Jeremy Salvucci from thestreet.com, written on September 1st, 2023, an in-depth timeline of the GameStop short squeeze saga. January 2021 saw one of the most notorious short squeezes in market history as Reddit's army of retail investors took on hedge funds to drive struggling retailer GameStop's stock price sky high. GameStop, a video game retailer known for operating stores out of malls and shopping centers, was the go-to name in the game and console sales industry and the arts. Once a favorite mall stop for America's youth, teens, and game-oriented adults, by the mid-2010s, the retailer began to lose both cultural relevance and market share as shopping mall traffic waned, and more of the gaming industry's customers began to opt for online purchases. By the end of the decade, GameStop's business was struggling, and it showed in the company's stock price. Hedge funds and other large institutional players in the market had already begun to bet on the retailer's demise, causing its stock price to dip below its per-share book value for much of 2019 as short selling drove share value downward. GameStop's legendary short squeeze was dramatized in the 2023 film Dumb Money, starring Seth Rogen and Paul Dano. When the COVID pandemic shut down much of the retail economy in early 2020, it seemed GameStop's fate was all but sealed. Over the next year, however, something unprecedented happened. A new generation of retail investors armed with pandemic stimulus money, unemployment checks, and lockdown-free time put their resources to work in a collective attempt to take advantage of the company's low share price and high short interest.
So I guess my first question, James, could you explain what a hedge fund is? Could you explain what short selling is? And anything else that you think pertains to the beginning of what we just heard?
Let's start with short selling. Let's start there. So we know what stocks are, right? Stocks are ownership in a company. That's the bottom line of a stock. When you buy a stock, you are an owner now in that company. Stocks can go all the way down to zero, and they can go all the way up to infinity. So really the playing field for stocks is wide open. And typically you want to understand the fundamentals of a company and how that business is being run in order to buy the shares, especially if you're a longer term investor. If you're a shorter term investor, more like a trader, you're more concerned about short-term pops in the price, and you're trying to time, buying it low and then selling it at a higher price in a short time frame. So that's a quick understanding of kind of the dynamics at play. So what's a short sale? A short sale is when an investor believes that a particular stock is going to drop in price. So what they try to do is make money by borrowing the stock at today's higher price, they wait for the stock price to drop, and then they buy back the stock at the lower price, and then they keep the gain in the middle. So an example, let's say a stock ABC is priced at $50 today. I think it's going to go down to $20, right? So I'll go to my broker and say, hey, broker, we've been doing business for a while. I've got good history with you. I like to borrow ABC stock at today's $50 price, right? Now, after, let's say, a month, the stock starts to drop, right? So now it's following my investment strategy. It hits 20, where I think it's going to hit, right? I then go to the market. I buy the stock back at $20. I borrowed it and sold it at 50. I bought it back at 20, $30 gain in the middle. That's my profit that I walk away with. That, in essence, is short selling. This is not typically a strategy that I or anyone else as an individual investor would normally get involved in. You would really want to be a super experienced individual investor if you're going to get involved in this. But institutions, and that's when we talk about the name institutional investor, AKA hedge funds, those are companies, investment-based companies that are investing on behalf of customers to make money. So institutional investors will look for a whole bunch of opportunities like that. They only need 2 or 3 of them to do well to cover the losses for the others and still make a profit for themselves and their customers. So the way institutional investors kind of cover their risk is by doing a lot of these, because they know that a certain number of them are going to fail, but a certain number of them are going to hit, and it's going to cover the losses they experience, plus be able to make a profit on behalf of themselves and their customers. Does that make sense?
It does make sense, but maybe something that Kristen has this look on her face that people
Yeah,
can't
yeah,
see. But
yeah.
I guess
Let's
the
make sure we
first
clear
question
that
I
up.
have, because a lot of people probably want to know, how do you borrow a stock?
Yes.
I thought you either bought it or you sold it, but how do you borrow a stock?
Understand, there are so many different things you can do beyond just buying and selling. And so we'll talk about 2 factors that kind of play into this story. So let's first talk about margin, and then later, like after Kristen finishes her read, we're going to talk about options as well. That's the other thing we're going to talk about. So that's another complication here, but we'll talk about that in flow of the conversation. When you borrow a stock, that's called margin. You've probably heard of the term margin or margin call. Right. So I would go to my broker and say, I would like to borrow ABC stock, meaning I like to margin ABC stock. I want to borrow it. So what the broker is going to do is they're going to loan me that stock either from their own inventory or from other customers that they manage. And they will loan me that stock, right? Now, there are normally terms with that, right? There's usually penalties, there's fees, there's interest that you're paying because it is a loan. Think of any other loan, like any loan you can think of, right? You're paying interest on it. All of those things also apply. Where margin call comes in is that, let's say that particular stock, ABC stock, is now in high demand. That broker can say, margin call, I need you to pay it back today because the people who own that stock want to do something with it. You borrowed it, now give it back. And that's called a buy-in, or covering the margin call. You're now buying back that stock today, even if you didn't expect to or plan to. You have to buy it back today and provide it back to the broker that you borrowed it from. That's margin call.
So you can purposely borrow a stock to drive it down to make money. Doesn't that go against the person who you borrowed it from?
Yeah, well, no, it's an interesting point on that, right? Yeah, it can. But if you're a savvy investor and you realize, oh crap, the stock is going down, I need to sell my stock. You're going to go to your broker and say, sell this stock, sell ABC stock. Now, if the broker has enough of that stock on inventory to cover for that investor, they will let that sale go through. If not, they're going to do a margin call, get the stocks back, and then sell the stock on behalf of that customer. So they're still going to honor that sale. But those are the dynamics that kind of go into this. But the point you made is important. When there are a significant number of short sales, it drives the price of the stock further down. So if enough people think a stock is going to go down, and enough of those people move forward with the short sale, guessing that the stock price is going to go down, it will actually have the effect of forcing the stock down.
From your understanding, I was told that hearsay and conjecture in the world of Wall Street can bring a price up or drop a price down. So people who are trying to short sell a stock will purposely put out disinformation and put out rumors, drive the stock down.
Yeah.
Is that a legal thing to do if you're borrowing a stock from another person that you're purposely trying to drive down?
Yeah, so let's talk about an important fact before we go to that point, and it's related. The stock market is not rational. Now, this is a James LeGrand opinion. The stock market is emotional. It is not rational. If it was rational, then based on market fundamentals, everyone would be making the same calls and everyone would be right every time, right? You'd have more predictability in the stock market because you would know based on these fundamentals, X, Y, and Z is going to happen, right? So the thought that the stock market is rational is inherently a risk to the person who believes that. The stock market is very emotional. In more than one situation, a rumor of fear, even or just the reality can cause investors to oversell a stock or overpurchase it, right? So those things happen all the time. I made money because back in the financial crisis because the market oversold, and I happened to be one of those people who went, the market's a little too high. I'm going to step out right now, sit on my money, wait for it to drop, and then buy in at a lower price. I did that, and that significantly contributed to me buying my dream house. So I was fortunate enough to see it, understand it, have the patience. I've been investing for a long time, and I was willing to sit out and miss potential gain, while the market was still going up, when everyone else thought it was going to go up, to be in a position to buy in once everyone oversold. So the market is inherently emotional. You have to understand that. So with that said, there are actors out there that will purposely put out information that's either false or it's good information, but with a super negative or positive bent to then move people emotionally to make the decision that they want them to make. It goes in both directions. So if you want people to stay in the stock market, hey, market's good, market's healthy, there's no issue here, there's no financial crisis, no recession, all those things. If you want the market to go down, you'll all of a sudden see the pieces come out that say recession fears are getting stronger, or these particular experts in industry say that the market is at a 65% chance of a recession, or this particular stock is now had 5 bad quarters, and and now we're seeing exits from the top investors in the world. All those different stories come out. There's a reason for those stories. They are chosen to move people emotionally in some cases. Now, some cases it's just reporting. These are the facts. This is what's happening. In other cases, there are people who will seize on those to say, this is the behavior I want, so let me give it that negative or positive bent to get people to move emotionally the way I want them to. And there's nothing more emotional than money.
Yeah. All right.
Right? When making it and losing it, right?
Yeah,
Money is a highly emotional topic for most people. So you're exactly right, Abdul. There are people who will actively market to get the behavior they're looking for.
All right. Kristen?
Yeah, that's crazy.
Did you have any questions on that, Kristen?
Any questions or comments?
No, I don't speak Spanish. Okay, so everybody just calm down. No, it's interesting though, because I did see the movie, and I did read through this article before, and it sounds like a lot of what you mentioned existed through this whole situation.
Yeah.
Throughout some of it. So I'll go on so that the listeners can hear what went down also.
Let me just do this really quick. So to make it super, super simple, right? Abdul and I are going to do a transaction, right? Abdul's got a deck of cards, and I want the deck of cards, right? Because I think the price of cards are going to go down. I borrow Abdul's deck of cards. I sell the cards at today's price, right? At $5. The price of cards goes all the way down to $2.50. Well, let's make it $2 to make the math easy, right? So now I buy back a deck of cards at $2 and give Abdul back his deck of cards. I made $3 in that transaction. I borrowed it from Abdul, sold it at $5. When it went down to $2, I bought it back at $2. I kept the $3 in the middle. That's a short sale.
Today's prices and yesterday's prices.
Yeah.
That's some next level hustling right there, and it's all like legal, but
that's exactly what legal, it is. It's all a hustle.
It can't be ethical because that's some gangster stuff right there. That's some.
Well, and remember, there's a difference between ethical and legal.
Oh, completely. Right? That's what I'm saying. So, it's legal, but it ain't ethical, right?
Well, the question is who gets harmed. right? And really, the person who, in this
Oh,
case,
the way
the
you
person
put
who's
it, no
doing this,
one.
I'm sorry?
The way you just put it, no one.
Well, the short seller could
Short seller.
absolutely be harmed. So I described to you a perfect scenario. He
Oh, okay,
borrows the
okay.
stock at 50, right? Sells it at 50, waits for the price to drop, buys it back at 20, makes $30 a share in the middle. That's the great scenario. What if the
Right,
stock
okay.
price goes up to 70, right?
Mhm.
So now
You
he
gotta pay
borrowed
that.
it at 50,
Mhm.
expecting it to go down. It goes up instead. It goes to 70. He gets a margin call. You got to buy back the stock today. So now he's buying back the stock at 70 a
Okay.
share. Now
And
he's losing $20 a share. He's underwater.
that is, I think, where dumb money comes in.
Or circumstance. You could be the smartest investor. And again, the markets are inherently emotional. For whatever reason, that stock has a rally, right? It could be that all your math, all your analysis is right on point, and you still don't get the desired outcome. So now you're losing money in that situation. So in this case, just on this side of it, the short seller side, there's a lot of risk. That's why typically institutional investors will do a lot of these because they know some number of them are not going to go the way they want them to go, but some number of them are going to go like crazy, like they're going to make a ton of money. And they hope that they'll make more than they lose when in the aggregate, when you put them all together.
But as gamblers, that's the chance they're willing to take on those that they.
Correct. There's a difference between being an investor and a trader. Investors have Warren Buffett's an investor. He thinks long term. He buys Coca-Cola because it's a solid business. There's a great marketing strategy, and you don't have to invest a lot more money in Coca-Cola to sell more Coca-Cola because you've got a dedicated, committed, ravenous audience that will buy from you, right? So Warren Buffett is an absolute investor. He thinks long term. The trader's going, well, Coke's got a new product coming out. I'm going to buy it before it comes, buy the share today, thinking that the price is going to go up. And then when it goes up, I'll sell it at the higher price. And I'm thinking about that in a 3-month time frame. That's a trader. That's gambling.
How is this not torturous interference if I'm purposely trying to tank the stock to make money? How is
And
it if I?
what they will say, what that institutional investor will say is, I'm not trying to tank the stock. I'm looking at my numbers and going, that stock's going to decline. So let me do something now to make money on that trade. Now, if enough institutional investors have the same thought, it has the net effect of driving the stock price down. Absolutely true.
And I agree with that, but you're adding the scuttlebutt with the borrowing of the stock to drop it down. I think the scuttlebutt part is the torturous interference part. I'm purposely saying things to drop the prices, and it harms the business. How as a business owner, how do I not see that as torturous interference?
Well, and I'll give you an example of where that's a problem. I think it was Elon Musk who got in trouble for that, right? For making a particular stock trade and then making comments about that stock that had the effect that benefited him, and then that went under investigation. So you're correct that that can cause trouble for that institutional investor or high-level investor as well. So you don't want to be the one. If you're the one doing the trade, you don't want to be the one putting out information that will then benefit you if you create the behavior you're looking for.
All right, Kristen.
By late January 2021, GameStop's, also referred to as GME, those are their stock letters, price skyrocketed to a pre-market high of over $500 per share in what was perhaps the most notorious short squeeze in stock market history. Here is a timeline of some of the key events that punctuated GameStop's journey from struggling retailer to trending meme stop to hedge fund toppling folk hero. Note, GameStop conducted a 4-1 stock split on July 2nd, 2022. All right, so here we go. June 1st, 2019, GameStop stock closes at around $7.47 per share. Mid-2019, Michael Burry's private investment firm, Scion Asset Management, purchases over 3% of GameStop's outstanding shares, believing the company to be undervalued by the market. July 31st, 2019, Bloomberg reports that GameStop's short interest stands at around 57,226,706 of 90,268,940, meaning that over 63% of the company's outstanding shares are currently sold short. August 16th, 2019, Michael Burry personally addresses GameStop's board of directors in a letter stating that his firm owns 2,750,000 shares, or about 3.05% of GameStop. Burry expresses concerns regarding capital management and urges the company's leadership to continue to use its cash to complete large stock buybacks in order to increase the company's earnings per share. Michael Burry, notorious for his big short on mortgage-backed securities before the housing collapse of 2007, invested in GameStop in 2019 and encouraged the board to conduct buybacks.
So, James, explain what a short squeeze is and explain Michael Burry's position with regards to buying a stock, then going into the board of directors and saying, hey, I own 3% of this company, and what you're doing is bothering me, knowing that on the backside, I'm looking to short this stock.
Yep. So Michael Burry, number one, everyone will remember Michael Burry from the financial crisis of 2008, 2009. He was one of the people who predicted that mortgages were going to crash, and he invested in a way that once those mortgages crash, his company will make a ton of money. So he has been on the other side of this in terms of investing. In this situation, he's now the investor who has purchased the stock outright for GameStop. Now, he bought enough of that stock that when he wrote to the board of directors for GameStop, they were like, yeah, we want to talk to this guy, right? Now, if you own 100 shares of GameStop and you write to the board, I'd like to talk to you, they're probably not going to take up that meeting. Michael Burry is another case, right? He owned enough shares. He was a significant personality. Everyone knew him. He's famous for making really good calls. So they took his call and said, okay, let's have that conversation. What he was saying to the board was, I'm concerned about the fact that there are short sellers on GameStop. He wasn't saying that he himself wanted to short sell. He was saying, I'm a stock owner, meaning I'm an owner in the company. I own 3% of this company. And I'm concerned that there are so many short sellers that the price is being driven down. What are we going to do? Is there a way we can manage the company differently, invest differently? What can we cut costs? What can we do to stabilize the share of the prices so I can stop losing money on my investment in the company? That's what Michael Burry was trying to say. And the short squeeze is the situation that we kind of talked about before. So again, ABC company, currently at $50, right? Someone else comes in and says, I'm going to sell it 50. I'm going to borrow the stock, sell it at 50. I hope it goes down to 20. Instead, the stock price goes up to 70. That's the short squeeze. That's where now, as the investor in that situation, I have to cough up money to make the people that I borrowed the stock from whole, but at a higher price. That's the short squeeze.
Okay. You got that, Kristen?
Nope. August 30th, 2019.
Hold up. It's important because I think if you don't get it, there's probably some listeners who aren't following either. So tell me what's
here's what's crazy is I get it, but I don't get it. I don't got it. Does that make sense? I get it, but I don't got it. Like I hear you and it makes sense to me, but for me to turn around and explain it to the next guy, forget it. It's not gonna happen.
You know what's funny about you ever see the movie Trading Places with Eddie Murphy?
Love it, yes.
Right. And he's in the room with the two brothers, right? They're explaining, how options work, right? And all this other stuff and how prices go up and down. And then Eddie Murphy goes, oh, you guys are a couple of bookies, right?
Yeah.
And they go, I think he's got it, right? That's really what this is. This is nothing more than buying and selling with some complication in the middle. And I think what startles people about this is they go, wow, I didn't realize you could do all this other stuff. I thought you could just buy and sell stock. I didn't know you could borrow stock, sell a borrowed stock, have to buy it back. I didn't know that all this other stuff existed. And then we haven't even talked about options yet, which we'll talk about on the other side, meaning what the Wall Street Bets team did, because they did some stuff too that most people aren't aware of either. So we'll get to that also. But yeah, it's the basics of buying and selling stocks are really basic, right? I buy a stock, I'm investing in the company, I'm now an owner. If the price goes up, that's fantastic. When I'm ready to sell, I'll make money. If it goes down, if I sell it, I'll lose money. But if that stock also pays dividends, which that's a whole nother thing, I can make money by just holding the stock and having dividends get paid, right, over time. So that's another piece, but that's not so much in terms of GameStop.
I like yellow.
Pudding is delicious.
And you know what? That's a good point,
No,
right?
no, I totally understand it.
There are 5 primary colors, and I'm a primary color guy. But then there's all this other stuff, right? That all these other, fuchsia. What the hell's fuchsia? Teal, right? I have no idea. I can't think in those terms. I think in terms of 5 primary things, right? Primary colors. In this case, most people think about buying and selling stocks, and that's it. But they don't think about margin. They don't think about calls and puts and all these other complications that you can do that more higher level investors will get involved in. So this market gets deep, like in terms of all the different things you can do and the different products you can buy. But for purposes of this, just think of, you can borrow a stock and sell it, but you have to buy it back to give it back, and that's called a margin call.
Yeah, that part. I definitely know about dividends, and it's crazy because I got a couple stocks. I got a little couple investments, and I get these emails, and it's like dividends have hit your funds, and it's like 0.01. I'm like, come on, you could have just saved that email, waited until the end of the year to let me know I had a nickel. But
right. Now,
James,
if you're Michael Burry and you own 2 million shares of that stock, that nickel suddenly has some value to it.
Yeah, that's a different show, Oprah.
Yeah, exactly.
Different show.
For James, for other people who we know and are possibly related to, could you explain this in cocaine sales distribution? If you buy a key and you get it on consignment,
there you go. In this case, you go to your neighborhood drug dealer, right? I can't believe we're doing this, but you know what? It will help some folks, right? You go to your neighborhood drug dealer and say, hey man, look, I'm short right now. I want to get some drugs to sell. Can you loan me the drugs to sell? You're going to loan me a key. I will pay you interest.
That's called consignment.
Right. Okay. I'm going to borrow this from you, right? I'm going to then, well, this is a little different, right? Because then in this case, you're going to sell it at a higher price because you're going to try to make money on it, right? And then pay back the key that you borrowed. So it's in the opposite direction in that case. So it doesn't quite work in this case. In this case, you're borrowing something at a higher price, hoping that the price drops. You're going to then buy it back at the lower price. In the middle, that you're going to get that price arbitrage. You're going to get that difference between the higher price you sold it at and the lower price you bought it at. That's your profit.
Kristen.
August 30th, 2019, GameStop stock closes at $3.97 per share. September 30th, 2019, by the end of 2019's third fiscal quarter, the company had repurchased and retired about 34% of its outstanding shares. December 31st, 2019, GameStop stock closes at $6.08 per share. July 2020, Keith Gill, aka Roaring Kitty, begins releasing YouTube videos explaining that he has held a position at GME since mid-2019, around the same time Burry bought into the company, and believes the company is undervalued and overshorted. Gill makes the same case on Reddit's Wall Street Bets as deep effing value. Is that right, James? That's correct, right?
I think that's right, yeah.
Deep effing values, because this is a family show, right?
We'll stay with that, yeah.
I know, right? August 31st, 2020, GameStop stock closes at $6.68 per share. November 2020. By November 2020, Ryan Cohen, an activist investor known best for his former role as CEO of Chewy, an online pet supply retailer, had purchased over 10% of GameStop's outstanding shares. November 30th, 2020, GameStop stock closes at $16.56. December 8th, 2020, GameStop hosts its Q3 earnings call. The company misses Wall Street revenue estimates due in part to pandemic-related store closures and reports an adjusted net loss of 53 cents per share, causing shares to slide sharply downward in after-hours trading. Fourth quarter 2020. At some point during Q4 2020, Michael Burry's Scion Asset Management exited its massive position in GameStop, according to regulatory filings. January 4th, 2021, GameStop stock closes the first day of January trading at $17.25.
Okay, so first question is about retiring a stock. How does a company Retire a stock.
Buying back a stock. Companies are allowed to buy their own stock to get it out of the market, which will mean less stock available to sell, which typically helps the price go up. So retiring a stock is, we have 1 million shares out there. I buy 250,000 of those shares back. There's only 750,000 shares now in the market. And I'm going to take that 250,000 shares that I purchased as a company purchasing my own stock. I'm going to retire it. They no longer exist as shares. So now my share price is going to go up because I have the same value, but less shares.
I was thinking of more like when a pimp has like 10 hoes on the block and he takes 3 of them off the stroll. So now the prices of the 2 hoes go up.
There you go. That works.
Go.
That works. That works.
What does that look, Kristen? Why do you have that look? Yeah, it's pretty one for one, don't you think? It's kind of the same thing.
Yeah, it's kind of the same thing, but it's
Gotta
crazy
take
because
them.
I was thinking of something else. But as soon as you threw pimp in the mix, just all my thoughts. I was, what? Where is he going with this? But I mean, I was like, honestly, I was thinking like, okay, if I am a publisher and I've got a bunch of books and I buy all my books, and I'm like, oh, there's only 50 out there, you guys. Ooh.
Right.
Limited edition or something like that.
Yeah. Yeah.
So is that ethical? Weren't musicians, artists doing that with their CDs?
Yep.
Trying to make it look like it was sold out so that people would be like, oh, I gotta get it.
Record labels were doing that. Yeah, they were buying back. They're buying back their
and creating a demand for what was out there, right?
Correct. And
so
rumor has it, and I'm not going to, there's specific companies in the diamond industry that may possibly be doing that to keep the price of diamonds high. Diamonds may not be as rare as we think.
I did hear that about a specific company that I'm not going to name because I don't want to get in any trouble.
Right.
So company was it's very well known in this industry. Yeah.
But you're right. But in essence, what you said is exactly right, Kristen. When there's less of something that holds a particular value, it can increase the value of those outstanding assets that are still out there and available for sale. So applied to GameStop. GameStop has short sellers. The term that they'll say is, I got short sellers all over me, right? They have all these short sellers shorting their stock. They've got investors exiting the position. Michael Burry, who's famous, and because of the amount of stock that he buys, he has to disclose to regulators what his plans are, what he's doing. When that becomes public knowledge, people go, well, I like Michael Burry. I trust him. He sold GameStop, so I'm going to sell my GameStop stock also, right? So that has a net effect of driving the price even lower. So now you have investors going, okay, buy back your stock to help bolster the price, help put some stability, get a floor under your stock price so it stops going down. So GameStop went into the market, bought back some of their own stock to try to stop the short sellers and kind of stabilize the price, and then they retired it. We're never going to make these shares available for sale again. It's a strategy to try to stop the stock from sliding down.
Can they come out of retirement? Can those shares ever come out of retirement?
At any time, a company can say, you know what, let's offer more shares. They can definitely do that.
I actually had one of my stocks that I had invested in slice the pizza into several slices. I still had my same amount of shares. No, I'm sorry, my value, but the shares had the number of shares had tripled or something crazy.
You're talking about stock splits or reverse stock splits.
I said I don't speak Spanish. No sé qué estás hablando.
Yeah, so I once owned a stock that, what was the price of it? I forget. Well, I'll just use ABC Company once again. Let's say ABC Company is valued at $30 a share, right? And they decide, okay, for every share you have, we're going to give you 3 shares, but your overall value stays the same. So I own one stock today for $30. Tomorrow, I'm going to now own 3 shares for $10 each.
Right.
That's a stock split.
Okay, that's what they did. Yeah.
That's what they did. Right. Okay. So you can do it in the opposite as well. You can say, okay, for every share you own, well, for every 10 shares you own, I'm going to give you 2 shares, right? Something like that. And then now here's your value. Now, instead of having 10 shares, you're gonna get 2. There's 5 times less. So we're gonna make the price 5 times higher, but your value overall for your portfolio stays the same. That's a reverse stock split, where
What
you're
would
now
be
gonna
the
end up with less shares, but the price goes higher.
what
So
would
there
be
are
the
companies that
reason
do that
for
as well.
why? Why? What would be the reason for a company to do that?
So their stock price goes up.
Okay.
And if you have a traditional company, I've got one in mind because I won't mention the name of the company because I made a mint on it. But they did this after. Now I completely exited my position with this company, so I wasn't impacted. I'd already made my money after the financial crisis, but their stock price went from like 70, like down to 5. Actually, it went down to less than 5. I won't say what the amount was because then I'll actually be giving away what company it was. But so now it came up to around $5 a share, and it's trading around there. And they're like, okay, we're this traditional big company. We're at $5 a share. We're used to being much higher. Let's do a reverse stock split. So they did a reverse stock split, a 1 for 3, 3 for 1. I forget how. I think it's 3 for 1 is the way I should say it. But it was a reverse stock split. At the end of it, the stock that you were left with was now worth $50 a share, but you had less shares. So you had the same value, but each stock, instead of being worth $5 a share, was now worth $50 a share.
Gotcha.
That's the reverse stock split. So now that after, when people have short memories, 6 months later, people forget that reverse stock split happened. They go online, they're looking for an investment. They go, oh, look, that company, $50 a share, they must be doing pretty good.
Can you explain to the general public and to myself and Kristen what a Q3 earnings call is? 1.
Yeah.
2, can you explain how Ryan Cohen's purchasing of the GameStop, 10% of GameStocks, how it affected the stock price? And then part 3, Michael Burry, they exited their position in GameStop. How did all of this, plus the pandemic, because we're missing that part of it, affect Michael Burry and the stock, and why he exited his position on the stock?
All great questions. So Q3 earnings call. So every quarter, publicly traded companies, meaning companies that have stocks on the stock market, that's called a publicly traded company, they hold earnings calls. How are we doing? So they're now talking to their investors. If you own stock, you can join these calls. In fact, a lot of times the media joins these calls as well. And the company is going to now give their perspective on how they're doing. They're going to say, here's our current plans. Here's what we're doing. Here's where we see our future. Here's where we see our growth, or we're in trouble, right? We're in trouble. Here's what we're doing to get out of trouble. We're borrowing money. We're, reducing the number of stores. We're going to add more game inventory, whatever it's going to be. But a quarterly earnings call is going to talk about the health of the company. It's going to talk about their plans, and then talk about whether or not they're on target for where they think they're going to be by the end of the year. Okay. So then Michael Burry sells 2 million shares of GameStop. The net effect of that is that it would drive the price down for 2 reasons. One, he has now put more shares on the market available for sale. So now there's a lot more out there than there was. So net effect is the price is going to go down just based on that. But then there's the second net effect of, people follow Michael Burry. I mean, he was absolutely a savant. I still think I think he's a savant myself in terms of how he looks at investments and looks at markets. And if he's selling, there are people who will just go, well, I'm not good at this. I'm not Michael Burry, but I trust him. I'm going to do what he's doing. If he's selling, I'm selling. So people will shortcut their thinking process by modeling after like a Warren Buffett, a Michael Burry, and other people, and go, okay, whatever they're doing, I'm going to do that too. So it would have had a cascading effect of other people also selling. So that's the Michael Burry side. For Brian Cohen first went, you know what? I'm looking at the fundamentals of this company, GameStop, and I think it's oversold. I think there's more value there than other investors believe there are. So trusting in the market and trusting in people being rational, I'm going to buy this stock price at this super low price, hoping that the fundamentals will kick in and the stock price will go up. So I'm going to buy 10% of the company now and then watch the price go up and then make some decisions on whether I keep it long term or eventually sell it. But that would have a net effect of increasing the stock price, especially if he's got a following of people who will go, hey, he's buying it, I'm buying it too. which kind of leads into his post to the Wall Street Bets Reddit page, right? Because that's significant to this story. He didn't just go, for me personally, I think this is a good thing to buy and I'm going to buy it. He told other people about it in this Reddit page, Wall Street Bets.
So Michael Cohen buys it, and him buying it says the stock is good to the general public. And Ryan Cohen, I should say, and then Michael Burry is selling it, and his position is that the stock is bad. So do they offset one another?
It could, but in this case, I don't think it did. I think Michael Burry lost money on this deal, right? And that's called cutting your losses, right? Not 100% of the stocks that you buy over your lifetime are going to all do well. And it's important to have, there's something called stop gaps, right? Stop losses. So in other words, some people will say, if I buy at a certain price and that stock loses 20% of its stock price value, I'm just going to sell at that point and cut my losses. And people have different stop points, right? Some will say 10%, some will say 15%, some will say 33%, right? That some people are willing to tolerate more loss in hopes that it will reverse itself and then turn into a gain. So in this case, I think Michael Burry had a stop that he was looking at, and that's called being stopped out. He got stopped out and said, I'm out. That's it. I lost more than I hit my limit for what I'm willing to lose on this. I'm now going to sell.
Kristen, keep going.
January 11, 2021, Ryan Cohen, the activist investor who owns over 10% of GME stocks, joins the company's board of directors along with Alan Attal and Jim Groove, two e-commerce specialists who also used to work for Chewy. Ryan Cohen, former Chewy CEO, bought around 10% of GME's outstanding shares before joining the company's board in January of 2021. January 13th, 2021, just a little special day, by the way, everybody. GameStop stock jumps to an intraday high of $38.65 on the news of Cohen and Company's appointments to the company's board. January 19th, 2021, Citron Research, a prominent GME short seller, tweets that GameStop's retail investors are, quote, suckers at this poker game, end quote, and that the stock will fall, quote, back to $20 fast, end quote. January 20th, 2021, Citron Research cancels a planned report on short interest in GameStop amid supposed harassment from GME bulls. January 22nd, 2021, GME's short interest stands at around 140%, meaning 40% more shares had been sold short than actually existed in the open market. This occurred because shorted shares were relent and shorted again. Shares go up by over 50% to close at $65.01. January 25th, 2021, Citadel invests $2 and, excuse me, 2.75 billion in hedge fund Melvin Capital, which is heavily short on GameStop. More than 175 million GME shares are traded, and the stock closes at $76.79. January 26, 2021, Elon Musk, CEO of Tesla and SpaceX, tweets "Game stunk" and shares a link to Wall Street Bets, the Reddit message board on which bullish retail investors discuss and promote GME. The stock surges, closing at $147.98.
One, explain bulls, explain bears, and explain what an activist investor is. And then the last part is, what the hell does Elon Musk have to do with any of this?
So if you're bullish on a stock, you think the price is going to go up. You're all in. You're like, this is going to go up. This is positive. If you're bearish, you think it's going to go down. So you'll hear about bulls and bears, people who are positive on a stock or negative on a stock. You'll also hear about bulls and bears as it relates to the overall market. I am bearish on the stock market. I am bullish on the stock market. You'll hear those terms. I don't know. I think a lot of times industries create jargon to confuse other people, right? So, but it's that simple. A bull is positive, a bear is negative. Elon Musk. So I think, and I'd forgotten about that part of the story. So Elon Musk posted something. It sounded like it was positive for GameStop, and then the price went up. Is that correct? Did I get that right, Kristen?
He said game
Yes.
stunk.
So you would have thought, and again, markets are inherently emotional. Who knows why that happened? You would think that if Elon Musk made a comment that it would have had the net effect of the price going down, but somehow the price went up, right? So that is interesting. But the most important part of this is now for all of those institutional investors, meaning companies that invest money on behalf of customers, these institutional investors that shorted the stock, they borrowed stock at one price, hoping the price would go down so they can buy it at a lower price and then make the difference in the middle. In those situations, the price went up. So now they owe money at this case. There's no profit at this point. They actually owe money to cover the stocks that they borrowed. So now they're freaking out. They're going, wait a minute. I thought the price was going to go from 20 to 3, right? The price is at 176. So I got to pay $176 per share for a stock I borrowed at 20. Oh no, right? So they're recognizing how much more money they're going to have to pay up. Now, here's the other dynamic that happens. When you buy a stock on margin, there's a requirement from the broker that you have to keep a certain amount of money on reserve with the broker just in case the price goes in the opposite direction, the price goes up. So now they're probably getting calls from their broker saying, hey, you borrowed at $20. The price is now, let's say it was at 50. You got to put more money in reserve to cover the fact that the price keeps going up. Now at $176, you know that phone call is coming in like, hey, you got to put a lot more money in the reserve just in case, we want to cover our side as well, our risk. We loaned you this stock for 20. It's at 176. You owe us a lot of money to give us back the stock, right? To get back the stock, put more money in reserve so we're covering our risk to some degree. So, so now these short sellers are under a lot of stress and they're going, what the hell's happening right now?
What's the difference between an activist investor and just a regular investor?
An activist investor will buy enough shares on a stock to then give them some weight where they can demand that they either be put on the board or the board listen to them, right? And an activist investor has an idea of what they want to have happen with the company. So now if you're the board, you're like, oh my God, an activist investor, these guys are pains in the ass, right? They're going to come in with no real knowledge on what's going on with the company and make all these demands that we fire a bunch of people, we do layoffs, we close locations. They're going to say all these things because they want to protect their investment and watch the stock price continue to go up. So activist investor, now if you're an individual investor, you love activist investors because now they're representing you in a room that you can't get into, right? So these activist investors tend to have an idea of what they think is the best thing to do to move the price up and make sure there's more value in the company. And some of them are really good. There's some really good activist investors who actually know what they're talking about and have the net effect of really improving the overall running and efficiency of a company. Then you have activist investors who just have a ton of money and really get off on just being a pain in someone's side, being a thorn in someone's side, and going, okay, you guys are gonna listen to me because I've thrown enough money around. So they're the gamut. They flow the gamut. You want the good ones. You want the ones that actually know what they're doing and that are thinking long term about that company's success, not the guys who just want to you get into the news for being an activist investor and have that chip on their shoulder to say, hey, look, the news is covering me because I'm now telling this company what to do.
Okay.
Yeah, they're the ones that march, Abdul.
Yeah.
Boom, boom.
Yeah.
I'll be all week.
At this stage in the story, the institutional investors are sweating, right? They're out of a lot of money. And there's individual investors who are buying in on the word of other people that if enough of us buy this thing in Wall Street Bets, right, in this Reddit forum, if enough of us buy this, we can drive the price way up, right? And then we can all win, right? That's what they're saying. We can all win.
That's Roaring Kitty and his followers.
Yeah. Now, Now here's where I'll introduce the options that I was talking about. What are options? An option, there's call options and there are put options. A call option, and this is, I'm just only going to talk about it from the perspective of how it impacted this story. I won't go into puts. We're just going to talk about calls for a minute. When you purchase a call, you are buying the right, but not the obligation to buy a stock at a certain price. Where that becomes, so let me say that again. You are buying the right, not the obligation. You're buying the right. You're buying the option to buy that stock at a predetermined price at some point in the future, and call options can expire. There's an expiration date. So now, let's say I'm in this Wall Street Bets forum. Someone's saying, "Hey, the stock's currently at 20. We're all going to get together. We're going to drive this price up." I can say, "I'm going to buy a call for," and a call could be 100 shares. You can buy multiples of these, right? I'm going to go ahead and buy this call close to $20, or I'm going to buy it, or set the price at, like, let's say 22, even though that's called being out of the money, right? A price slightly higher than what it is today, right? Why would I do that? Why would I? So it's like an insurance policy. I'm not paying $20 a share for the call. I'm paying for the right to buy those shares at a predetermined price. So that call might be, $1 per share, to give me the right to purchase it at $20 a share in the future. So it's another technique that large companies and individuals will use to kind of hedge their bet. So I think the price is going to go up. I believe what they're saying in Wall Street Bets, but I'm not going to pay the $20 a share right now. I'll buy a call at $1 a share to give me the right to buy it at 20, just in case it starts moving.
So are you saying that when that share does go a crazy price, I have purchased the right to buy it at that lower price?
Yeah, that's correct. So now I buy, let's keep it easy, right? I buy 100, I buy calls for 100 shares, just to make that math easy, right? At $1 a piece. I spent $100 for the right to buy that stock, GameStop, at $20 a share.
Okay.
GameStop goes up to $176 a share. My call is still good. I haven't hit my expiration date, right? I've spent the $100, $1 a share to do that. Now I can go in and say, now I'm going to buy GameStop at $20 a share.
Right. That's crazy that you can do that.
It's like an engagement ring. You're not paying for the vagina. You're paying for the option to use the vagina.
Exactly.
At a later date, yeah.
So we talked about borrowing at margin, right? Borrowing stocks, that's called margin. That's thing that a lot of people aren't aware of. There are other options that you have, calls and puts, the right or the obligation, depending on whether you're buying or selling a call, or the right or obligation to sell a stock, and that's a put. All those options are in play here as well. So when we talked about margin for the side of the institutional investors in the game they were playing, on the other side, the people in Wall Street Bets were playing on this side and going, we're going to buy a whole bunch of calls at close to the existing price for GameStop, so that and that will, by the way, the effect of buying calls also drives the price up. We're telling this forum, everyone, let's do this, buy this stock, and now everyone's doing it. The price is going up. So all that had the net effect of driving the price up to screw the institutional investor. So that's the other part of the other side of this that I was mentioning, that we can debate the ethics of it, but it is absolutely legal to do.
All right, Kristen.
January 27th, 2021, equity and options trading volume in the U.S. reaches its highest ever single day level, 24.5 billion shares and 57.1 million contracts traded, respectively. GME sees its highest close of the squeeze at $347.51 after reaching an intraday high of around $380. Melvin Capital and Citron cover most of their short positions at staggering losses. January 28th, 2021, GME reaches a pre-market high of over $500. Robinhood, a fee-free trading app popular among GME's army of retail investors, along with several other popular brokerages, halts buying of GameStop stock, but continues to allow sell orders, angering investors and suspicions of market manipulation. GME closes at around $193.60. The U.S. Financial Services and Senate Banking Committees plan a hearing for February 18th to discuss the GME phenomenon. February 2nd, 2021, Janet Yellen, U.S. Treasury Secretary, requests a meeting of regulators to discuss the volatility created by the recent wave of retail trading. GME closes at $90. February 4th, 2021, Robinhood lifts remaining trading restrictions on GME and related stocks. GME closes at $53.50. Robinhood CEO Vlad Tenev took a lot of heat from retail investors who believed his company purposefully halted trading of GME during the short squeeze because it was allied with hedge funds that had short positions in the companies. February 18th, 2021, a hearing titled Game Stopped: Who Wins and Loses When Short Sellers, Social Media, and Retail Investors Collide is held by the U.S. House.
Okay, James. So explain Robinhood and their position and what they had to do with this particular story. And then do you know any of the details about the hearing that happened?
Sure. Good
Can I
question.
jump in here? Because I want to
Yeah.
say, I think I understand some of this actually. James, was it dealing with Robinhood? Did they pause because their investors didn't have money to make up for that margin? And
So
they didn't have the money to cover that margin. That what it was? They were like, everybody just calm down. We don't rock that hard. Is that what it was?
I'm
Or
not
hold on,
sure.
let me ask the second part of the question.
Yeah, yeah.
Or the second part of the question, were they colluding with another party who was making money on the stock that told them, hey, you may want to stop this because we're losing money and we're your financial partner in this?
Right.
Yes.
I don't know the answer to
In the
why
movie.
they did it, but here's the effect of what they did, right? By stopping purchases, they stopped the price from going up, right? They stopped contributing to the price going up because they stopped their investors who, and by the way, Robinhood, a lot of millennials use Robinhood. A lot of 20 somethings would use Robinhood because they were a no fee platform. And kind of Robinhood really catered to that market. That also happened to be the market that was really involved in Wall Street bets that were helping to pump this price up, right? So that's a lot of the investors that were doing this as individual investors, they were doing it on Robinhood's platform. So by Robinhood saying, we're not going to let you buy GameStop anymore, but we're going to allow you to sell it, the net effect is Robinhood took a position that they were driving the price down. We will stop activities that will bring the price up, so we'll stop purchases, but we'll allow you to sell all you want, bring the price down. That's problematic, and that's why there were hearings. Did Robinhood do something nefarious? Were they in cahoots? Those are the types of questions that come up in a hearing, and it was appropriate to have those hearings. I don't recall the net effect of those hearings, but that what they did was shady as hell. Yes, and the point that you mentioned, Kristen, in the story, that were they in cahoots with these investors who had these massive short sale positions? A lot of those, so these institutional investors some of them were probably on Robinhood's platform. They probably borrowed some of these stocks, right, and now had to pay it back at these significantly higher prices. And some of those companies could, depending on the size of the company and the assets they had, this would have, I could easily see where this could tank a company depending on the amount of risk they took on. So
if I recall correctly, there was an affiliation with one of the major hedge funds.
Melvin, the guy Melvin, yeah.
There you go. There you go. So the net effect of what they did was by stopping the purchases, they were ceasing them contributing to the price going up, but by allowing sales, they were contributing to bringing the price down. That is, for some people, a form of market manipulation. I'm saying it that way specifically because I don't want to get into the legal wrangling on this, right? That's what the hearings are for. That's where the regulators come in and look at it and make a determination. So that was absolutely suspect enough that it demanded further investigation, and that's what happened. Janet Yellen, so let's talk about her. Janet Yellen is the former chairman of the Federal Reserve. The Federal Reserve has two jobs, only two jobs. They manage the printing of money on behalf of the U.S. government, and we'll talk about that too, because that's another story for another day. But the other thing is they set interest rates, right? And the thing that the two purposes that the Federal Reserve kind of does with those two tools, right, printing money and setting interest rates, they try to make sure that they manage employment. So they try to manage where employment should be. Should we have a certain level of unemployment or whatever? And they manage inflation, right? What should our inflation targets be, right? So they're probably looking at this as well and going, hey, there's some of the companies that get involved in stock trading fall under the purview, meaning under the review of the Federal Reserve, right? The Federal Reserve is the regulator for some companies. So there are banks, especially investment banks, that have to report to the Federal Reserve. Some of those banks might have been involved in some of this short selling activity. So now the Federal Reserve's going, how bad is your exposure to this problem? How much did you short sell? Do we need to come in and put rules in place? Are you still a viable company that can service customers? So that's where the Federal Reserve is coming in as a regulator and going, how bad is this for each of the companies that they, or each of the banks that they regulate?
If I'm a just a regular average Joe trying to get my money, put it in
Yeah.
stocks, or if I got, I don't really do stocks like that. That's a whole nother conversation.
You a regular Joe.
This is a nigga hush part of the conversation. If I'm a regular Joe,
yeah,
and all this stuff is going on,
yeah,
why would I even jump in this market? Because it just feels like I'm just the money that the ones that people are just taking the money from. They're just raking me for my money while they're doing this awesome manipulation at the top of this thing, and I'm just a pawn in this whole thing.
It's called momentum. The problem on the way up and on the way down is herd mentality. So there are people out there that are going, hey, if everyone's buying GameStop, and I'm hearing about it in the news, it must be good, right? Now, typically those people tend to lose the most. Here's why. So you're in this Reddit group, right? You're one of the early people in this Reddit group, right? In Wall Street Bets. You're buying the stock at $20 a share, right? And everyone's piling in and forcing the price up. By the time it's at $300 a share, and the mom and pop store, the grandmother, the 19-year-old in college, by the time the person who's trying to retire hears about it at $300, they're going, well, it went up from 20 to 300. It's probably going to continue. I'll buy it at 300, right? So now people are still piling in because of momentum. Again, markets are emotional, right? It's not that people are going into GameStop looking at the fundamentals in terms of their debt to equity ratios and how many stores they have available, the contracts they have with gaming companies. They're not looking at the fundamentals. They're going, I keep hearing about it. The price went from 20 to 300, and I'm hearing it's going to go even higher. I'm going to buy at 300. Some people will have called this, I'll say it that way. Some people will have called this a scheme, right? The scheme is called a pump and dump, right? Where you get a whole bunch of people together, you pump up the price, right? But because you were in early, you're now selling early before you tell everyone else to sell. So it hits 300, I sell at 300, then I go to Wall Street Bets and go, hey guys, just letting you know, I'm selling, right? And now everyone's selling. And now if you're one of those people who got in late and you're hearing late that the price that everyone's selling, so now it comes all the way back down to 100 from 300, now you lost $200 a share. So that's called a pump and dump. You pump it all the way up, and then you dump it, you sell it, and then everyone else sells it. And you'll see with GameStop, the price yo-yoed several times. It went up and down, up and down, up and down. And not as high. And here's the interesting part. The highs didn't go as high and the lows didn't go as low, right? So you saw these extremes between 20 and 500, but then it was going down like 23 to 150, back to 30, and then it was 100, and you'll see this yo-yo effect that started to happen. But as much as the early individual investors on the Wall Street Bet side were making money because they were setting the buy and sell dates. So that's the problem with these situations, especially when you don't know what you're doing, you're just following the crowd. You don't know when the leaders are going to reverse course. So if you're not on it every single moment, if you don't have that kind of time, if you work a full-time job, you may start the day and check the stock price and go, it's at 300, feeling good. And at the end of the day, you check and you go, holy crap, it's at 150, right? And you just lost half your value because you're not on it every moment of of the day.
We used to do pump and dumps all the time at the club. Find a nice little, anyway, never. Kristen.
Robinhood CEO Vlad Tenev speaks, assuring the panel that Robinhood does not have inappropriate relationships with hedge funds, claiming, "We don't answer to hedge funds. We serve millions of small investors who use our platform every day to invest." Tenef claims that trading was halted because the clearinghouses that conduct the actual trades made on the company's app raised their prices. GME closes at $50.31. February 19th, 2021, GME falls to its post-squeeze low, closing at $40.59. March 12th, 2021, GME reaches a post-squeeze high, closing at $264.52. After March of 2021, GameStop's stock continued to see fairly drastic ups and downs, but none were as stark as January's short squeeze. Overall, the trend was down between early 2021 and late 2023. The stock remained popular, however, among both retail and institutional investors, and among both bulls and bears, seeing higher volume and volatility than it had in years leading up to 2020. Whether the company's directors' shakeup and strategic shift toward digital sales will spell long-term success for the video game retailer remains to be seen.
So
And I just say I remember all of that in real time.
Yeah.
And
Yeah.
I do have Robinhood. I got a couple coins, crypto or something dumb in Robinhood. And I remember not being able to do anything when they said that when they had paused it. I did watch the movie. The movie is kind of helpful with like the series of events. But I remember GameStop, and I was familiar with GameStop because of Ari, you know, buying games and all that other stuff, but I wasn't a follower of Roaring Kitty. But I remember thinking, oh, is this something maybe I should buy a couple of stocks in? Because I had a little bit
Right.
of money and I was
Right.
doing a little bit of investing at
Right.
that time. So I'm kind of, when I watched the movie and, you know, some of the people who did, you know, turn a profit, I was just like, oh man, that could have been me. It hurt.
And that right there is exactly what I was referring to in terms of the people coming late to the
Emotion.
party, right?
Right.
The fear of missing out, right? FOMO,
Yeah.
fear of missing out.
Yep.
So now you're hearing about people who became millionaires because of this, right?
Yeah.
They bought it at 20, sold it at 300, and they're like, yeah, you know, they're feeling really good, right? And then you hear that story and you go, well, I want to do that, right? I'm on that platform. Why can't I do that? I mean, what's the price at now? I'll just jump in and buy now. What do I have to lose, right? And that's usually the beginning of the end. So now it's toward the end of this, you know, up and down, up and down, up and down. Now more people are losing money than making it.
Right.
And that's what typically happens toward the tail end of this. The people who get in later, who are getting in on the story they heard about everything that happened prior, they missed the momentum up phase. They're now hitting it during the momentum down phase.
Unless it was low, I wouldn't do it now. I mean, but I remember in real time, like thinking, oh, maybe I should grab a couple.
Yeah, well, so here's what I would say, and I'm not going to give advice, right? I am not a investment professional. I'm not
no advice,
right? I'm an individual who does my own investing. I have worked in financial services for a long time, but by no means do I have a Series 7 or Series 6 or any of these other things that you need to get involved in insurance or investing or any of those things. So make that clear. Here's my opinion. For me, I would I'm personally steering clear away from this, and have been steering clear away from it from the very beginning, because investing based on the number of other people investing is a gamble, right? That now you're not investing, now you're trading, right? And for me, at least, I'm a person that creates an investment thesis, meaning I see a direction for a particular market coming up, right? Who are the players in that market? I then figure out who those right people are for me that I plan to invest in. And then I'll purchase those stocks, right? And that's where I play, right? And then, but my perspective is always long term. So I set stop losses, and if a stock hits my stop loss, I stop out. I'm out. I'm very disciplined about how I invest. In this case, this is very undisciplined. You had one guy who said, I think the stock is undervalued. I'm going to buy it. I'm going to buy 10% of the company. Everyone else seemed to just follow along. He said it's undervalued. Let's follow him. Oh, he's posting in Wall Street Bets. He's with us. He's our leader. He's going to tell us when to buy and when to sell, right? So, but if I'm him, think it now. And again, what's legal versus what's ethical is a question. If you're him, when you're ready to sell, at what point do you tell everyone else you're going to sell? You're going to go in and go, okay, I'm going to sell today. Sold. Oh yeah. Hey, Wall Street Bets, by the way, I just sold all my stock, or I sold X% of my position, right? So you're getting the full gain in your sale, right? Now, as people find out, they start selling, the price starts coming down. The people who are in the back end, the people who found out last are losing, right? Because, and they're losing either because now the price is below where they bought in, or they're losing because they're not getting as much of their unrealized gain, meaning the gain they have on paper before they sell, right? But when you sell, it's an actual gain. When you sell, when it's just in your account, that's an unrealized gain, right? So they have this unrealized gain that's this big, but when they sell, now it's this big because they sold later than everyone else. So that's the danger of these of I don't want to call it a scheme, but of this situation on the Wall Street bet side. There are winners and losers there. There are massive winners and there are massive losers.
In the movie Wall Street, there's the famous line that Michael Douglas says, "Greed is good." So, is greed good? In this particular instance, proletariats, working class, were, for lack of a better word, greedy enough to want to keep at this thing to undercut the aristocrats. So, is greed good? What is your definition of greed? When we talk about stocks and Wall Street, is that just a fundamental part of just the business, greed?
I would say that before I answer the direct question, I would introduce that there were some of these individual investors in Wall Street bets that just wanted to stick it to the man, right? They were like, look, these institutional investors make all this money. Here's my time to get in and stick my salty thumb in their eye while making some money doing it. So there were people that just had the perspective of let's screw them, right? There were people who absolutely had that. So as a motivation, there were people who were greedy, right? We can make a killing doing this, but there were also people who were just angry and were like, these guys screw us all the time. This is our chance. We finally have our moment. Let's screw them. So that was a motivating factor as well. So I just want to introduce that to this as well. On to your question on greed. My opinion, I am a capitalist, right? I do believe in, making sure that you're providing, services and products to the market that people want to buy and utilize. And then everyone can win. Someone gets something of value, whether that be a service or a product, and you get something of value. You get the money in exchange for that. So you can go ahead, profit for yourself personally, but also create, reinvest some of that money to create better products and services and keep that cycle going. That's capitalism in its purest form. Where capitalism gets distorted is when people get greedy. How do I provide less value but make more money? Right? So that's greed. That's where it's like it's money at all costs. And that's where I separate, right? I believe in capitalism. I don't believe in taking advantage of people. And that's where greed gets in. So greed, and you'll hear, let the buyer beware, right? You'll hear that comment. Well, if you're a true capitalist, you should let the buyer beware. True, but I believe in honest brokering. I believe that an honest broker, I buy a product and like I love Amazon, right? Amazon.com. When I buy something on Amazon, if there's something wrong with it when it arrives, Amazon's going to make good on that, right? I can return something on Amazon, get my money back same day. Amazon operates as an honest broker. So I do work on Amazon's platform. I'll buy from Amazon because I trust them, right? And they've proven that trust to me multiple times, as recently as 2 days ago, right? I got something that, a product that was defective and they made good on that, right? So that's capitalism at its best. I pay Amazon for Prime services and I get the value that I believe equals or exceeds the money I spent. Amazon wins because I'm paying them and I continue to stay on their platform, right? So that's capitalism at its best. In Wall Street, the movie Wall Street, wake up, bud, bro. Money never sleeps, right? That whole line. This guy, he would take advantage of anyone to make the money. He wants you to lose so he can gain. That's how I'm defining greed for this conversation. And I don't think that, now again, legal, yes, it is. We absolutely have the legal system that allows for that. And we have a statement for that, let the buyer beware, but it is absolutely not ethical. So in the tradition of let the buyer beware, I would say that everyone needs to understand the risks of what they're undertaking for any investment they make before they make it, right? You have to have an exit strategy. Like if I'm buying a stock, if I'm buying a business, whatever I'm buying, do I know what I'm going to do with it to get out of it? right? What my advantage in the crash of 2008, 2009 was I understood the fundamentals of the companies that I was looking to buy when everyone else was selling. So I was able to recognize an oversold condition, meaning the value of the company was higher than the stock price. So I went, wow, and I know this company really well. I'm going to buy at the super low price, but I had an exit strategy. When it hits a certain price, a certain stock price, I'm going to exit my position. And again, I'm very disciplined about setting my investment strategy. So I bought it at a super low price. I sold it at a significantly higher price, 5 times what I paid for it. And I was able to exit. And, and at that point, people were still saying, I can't believe you're in the stock market. But when people were in the stock market, I was going, I can't believe you're still in the stock market. This thing's going to drop, right? So you have to have a position, and you're not always going to be right. I happen to be right in that moment. There's plenty of times I've been wrong. In that moment, I was right. I had an investment thesis, and I stuck to it. So I think in terms of greed, you don't want to abandon your solid thinking, solid research, pulling up the annual reports, reading through the 10K, doing all of those things that an investor should do before they buy a stock. You want to have a really firm understanding of what you're buying. But if you're going to buy based on someone else's opinion, well, then that's a risk also, because now you're risking whether or not they're right, versus doing your own research. I just believe in individual thought. So to answer your question on greed, is greed good or bad? I think it depends on the person with respect to making money. In terms of being ethical and living a solid life and doing those things, I think it's all the way bad, because greed, just inherent in greed, is taking advantage of other people. And one of my philosophies is, you get back what you put out. So if you're purposely creating losers, eventually you will lose.
If the stock market is no different than gambling, how is greed not an inherent part of the product? It's like, isn't it baked into the business model? And for the average person, myself, Kristen, and several others, why would we even get involved in this thing if when the big guys like the '08 crash that you spoke of earlier, when they get in trouble, they get bailed out? Well, why would I participate as a just a regular Joe Schmo in this thing? Because they need our money in order for them to get rich. That's how the scheme works, right?
Yeah, let me take those in turn, because those are great questions, all of them. So let's start with the platform itself, the stock market. It's not that the stock market is inherently gambling. It's in terms of how you use it. You can use it to gamble, or you can use it to invest, or you can choose not to use it at all. So Warren Buffett is an investor. He uses the stock market as an investor. And over time, he has a really good track record of making money for those people who buy his stocks, right? So he uses the stock market as an investor. He also buys a whole bunch of companies directly, and that's called private equity. That's a whole nother thing. And owning Geico and getting free money on premiums to be able to invest, all of that's baked into his success. And again, the story for another day. But he's an investor. He does not use the stock market as a gambler. He uses it as an investor. Those who use it as a gambler, there are people who have day trading strategies that are just straight gambling and hope, right? I'm gonna buy it at 3 cents and hope it goes up to 5 cents, right? There are people who do that, and there's a lot of risk that you carry when you do that. So again, I think each individual needs to decide: am I an investor or am I a trader? And then understand the risks and rewards that go with each of those scenarios, right? So that's one. I just want to cover that point. So the market itself isn't inherently gambling. It comes down to how you use it. You can use it to gamble, or you can use it to create long-term investment strategies. On your question on why would anyone get involved in the stock market, here's the answer. Most of us are in whether we want to be or not. If you have a 401k, you are invested in the stock market. Most likely the S&P 500. Our 401ks, pensions, all of these things, typically they are invested by investment companies in the stock market. So even if you don't have your own individual brokerage account, if you have a 401k or a pension, you're in the stock market. So you should care, because based on their investment philosophies, you are potentially being impacted. So let's take a 401k. 401ks will typically say, here's a couple of different profiles. If you're if you're age 60 and above, here's your profile. You should be more conservative. If you're age, 22 to 25, you should be more aggressive because you've got more time, so you can take on more risk, right? Those are the types of profiles you'll see in a 401k. They also have self-directed parts of the 401k. We can take part of the money, and now you can direct it into exchange-traded funds, ETFs, right? Which are, another, again, a story for another day. But if you have a 401k or a pension, you're in the stock market. Now, to get to the heart of your real question, why would I take the time and money to open an individual account and then try to pick stocks, right? Why would I do that? That's an interesting question, and it's something that each individual person and family has to answer for themselves, right? You can buy indexes. You can just buy the stock market. I'm going to buy a fund that closely tracks to the S&P 500 because overall, I may not be a good investor myself, but the S&P 500, if I track that over time, it's been going up X% per year over a certain amount of time. I think that trend is going to continue. I can just buy an index fund that mimics the S&P 500, and now I can go along with the gains and losses of the entire fund. You can also do that with the Dow Jones Index. You can just buy a fund that does that. Or you can buy individual stocks, and good luck to you. A cousin of a friend of a mother of a family member said, I should go in on this stock, so I'm going to buy it, right? People do that stuff all the time. So the investment decisions to go forward and open up an account, that comes down to each individual person and the risk tolerance they have and what that will do for their family. So when we get to the life lessons, I'll talk a little bit more about that part.
If you can, if you're a big enough company or a big enough hedge fund, you can buy a rating from Standard & Poor's. Essentially, you can buy information behind the scenes. You can do all this stuff that allows you to get the edge on the market as opposed to the average person. How is this game not rigged?
Yeah, let's talk about that because I want to back off a little bit by saying that you can buy a rating, but
I didn't buy in the
no, I hear
not
you,
in the technical sense, but yeah.
But what happened? Rather than say that, here's what I will say: with the 2008-2009 crisis, there were stocks being rated as top level that had mortgage-backed securities that were built with subpar mortgages. In other words, when all of the highest credit mortgages were wrapped up as mortgage-backed securities and being sold, and these companies want to make more money, they put in mortgages that weren't as secure into these packages, these mortgage-backed securities, and sold those at the same rating. And the ratings companies just slapped on the same rating and said, yep, looks good to me. That actually happened. So yes. To your point there, that is something that happened then. I think the rating companies would say today that they've made significant changes in what they do and how they do it so that those situations don't happen again. So I'll leave it at that. And I think, as time goes on, we'll see if that's actually true. But is it a rigged game? You were also correct in something you said earlier about the too big to fail companies, right? There's a great HBO movie called Too Big to Fail that I encourage everyone to watch. My wife gets tired of me watching it. I've watched that movie. I don't think I'm exaggerating when I say at least 25 times I've watched that movie. Because again, I'm not giving investment advice. I am telling you what intrigues me right now. What intrigued me was the response to the crisis, because the response to the crisis impacted the stock market, right? So we had these companies that had all of these mortgage-backed securities, right? The underlying mortgages are no longer being paid. People stopped paying their mortgages. So the securities themselves were unraveling. But these companies, these really big companies, bought what's called credit default swaps, right? Yeah. Here's another product. Basically, think of it as an insurance company. They went to a company and said, hey, we're buying these mortgage-backed securities. If for some reason our investment goes down, we want to buy an insurance policy from you that says, if it goes down in a certain way, in a certain amount, you're going to make us whole. Why would a company sell a credit default swap? Because of the fees. They're getting paid basically insurance. I'm going to equate to insurance. They're getting paid insurance premiums for carrying that insurance. It's kind of like having, you put insurance on the house because you hope it doesn't set fire. But if it does, the insurance company will come in and pay for everything, right? That's the scenario here. That people were saying real estate never goes down. So the thought then was selling a credit default swap on companies buying mortgage-backed securities was a good bet. You know, these mortgages, of course, they're going to be fine. Of course, they're going to get paid. They have an A rating. Everything's good, right? Well, when the mortgages started to unravel, and these companies went to the companies that they bought the credit default swaps from to say, "Hey, I'm losing money on this. Pay me now. Pay make good on the insurance policy." These companies that were selling these credit default swaps said, "Hey, we took on so many of these, we can't pay."
AIG.
Well, yeah, AIG was one of them, right? I was trying not to say a name, but yes, AIG
my bad.
took on an incredible amount of these, right? So AIG basically said, okay, we can't pay. We're going to book massive losses and go out of business. Now, each of these companies that took on a ton of risk with these mortgage-backed securities, some set of them were going to now have to log massive losses and also go out of business. And that's why the entire financial services system was in danger, that we almost lost our entire financial system under that, right? So too big to fail became a name because if we let some of these businesses that had, tens of hundreds of thousands of employees manage millions, billions, and trillions of dollars of people's money, that was all going to get lost in this, right? So we're talking about jobs, we're talking about people's investments, and we're talking about the actual structure of the entire system. So the Federal Reserve and the Treasury Department stepped in, did some things to save the system, and then coined too big to fail, or now also known as significantly, what's it called? GSIFI, Global Significant Investment Financial Institution, something like that. But there's a term that they use that's different from too big to fail, but it equates to too big to fail, right? So these are companies that if they start to go under because of their investments, they have been saved by the US government through the Treasury Department and through the Federal Reserve, through the Federal Reserve System, the Federal Reserve banking system. I personally bank with one of the too big to fails because if they get in trouble, there's a higher chance that they're going to get rescued because they got rescued last time.
Yes or no? Is the game rigged? Is the system rigged? Is that a yes or no question?
I am not able, as a current employee of the financial services system, I am not in a position where I can answer that question. What I can say is,
so if I say it's strategically structured, can you or disagree?
What I would say is this is still a system where you can make money, right? Because I'm also proof of that, right? I have done well in my investments. Again, I've lost some money, I've made money, I've made much more than I've lost, right? And I absolutely keep an investment thesis that's always running and updated. And I think in terms of 3, 5, and 10 years ahead, right? So I do better as a longer term investor. There are probably some people listening that do better trading it within the day because that's a specific skill set as well. I have a son that does amazing at crypto. Amazing. He's amazing at crypto. He's made just tons of money in that, right? I can't do that, right? I'm better here on longer term investing. He's better in crypto. Someone else listening is going to be a really good day trader. We all have to figure out what we're good at, invest the time and energy in learning that part well, and then doing it. Because if your money's sitting in your bank account, you're losing money. So let's talk about that very quickly. How are you losing money? You're losing it to inflation. You have $100 sitting in a savings account, making, just to keep the math interesting, 2%, right? Inflation's at what right now?
Not even giving you 2%.
Right. I won't even name what it is right now because depending on when people listen to this, but it's higher than 2%. So in essence, you're losing value in your money every day it's sitting in a savings account. So you have to find someplace better than what the savings accounts are paying, and so if that's what you're interested in doing, to make money just to stay even. So you need to be making at least the rate of inflation on your money just so your value stays at 1, just stays level. If you're not making a percentage that's equal to or greater than inflation, you're losing money every single moment.
This all feels like 3-card Monty, and the house always wins. So.
The house is going to win, no question. But I do honestly believe that individuals can win too. You just have to be more disciplined and smart about it. So one of the things I did before I really started investing is I found really good newsletters that don't just say invest here because we say so. They fully explain their investment thesis. Here's why this market makes sense. Here's who the winners are in this market. Here are 3 different ways you can enter and make money from this if all goes well. And here's your risk if things don't go well. There are really great investment newsletters that are worth their weight in gold because they teach you how to invest. So I didn't just learn options, by going to Wikipedia or some other place. I learned because for over the course of years, I've been reading these investment newsletters that have been teaching me how each of these different devices work. And then I get to make a decision. Will I buy a call or sell a call? Will I buy a put or sell a put? Does it make sense for me to buy stocks in this market? Does it make sense for me to buy bonds in a particular market? Does it make sense to buy precious metals or crypto? And within crypto, should I be buying Bitcoin, Ethereum, or the newest thing that's hitting the market that's way undervalued right now, right? These newsletters will walk you through exactly how to do that. I belong to one in particular they're just phenomenal in how they explain things. And they're out there. I also belong to one that it used to be really good and turned more political. So I will be using them a lot less than I use the one that just over time has just been so consistently good at teaching and consistently good at being right more than wrong. So they're out there.
But I know that you have a passion for this stuff.
Yeah.
And your son, who I'm not going to say his name on the air, he has a passion for this stuff too.
Yeah.
But as a proletariat myself, who just regular job, regular degular, and everybody else who fits in that category between jobs and kids and all the stuff that you want to do outside of your life, it really seems like unless you're willing to go all in 100% balls in to figuring out this investment system and using all of your spare time, you're going to be always on the losing end of this thing or following somebody who can manipulate you in the process.
So there are strategies where you don't have to go in 100%. And again, this industry has terms that they have jargon that makes it difficult for people to follow. They call this strategy dollar cost averaging.
Yeah.
What that is putting a little bit of money in over time consistently. So let's say every time you get paid, you take $100 and you put it into your investment fund. And you do that for 5 years. You're dollar cost averaging in to your investment by doing that. You're taking a little bit of money over time, and it will eventually turn into a big pile of money. And hopefully it's growing based on what you invest in, right? That's one way. Another way is you buy assets that have really good dividends. There are companies that have paid dividends consistently every single quarter for 100 years, right? So with that kind of track record, you can go, well, I don't care if the price goes up or down. The dividend's going to pay, right? And then if you're really good, you'll do a dividend reinvestment, right? You'll take that dividend and buy more of that stock with the dividend, and over time, that's called compound interest, right? You're taking the gain from the dividend and reinvesting it. That's one of Warren Buffett's secrets, right? He said compound interest is the 8th wonder of the world, right? That's how he does it. So you get a dividend. You do this while you're younger. You take the dividend, reinvest it, buy more stock. Take the dividend, reinvest it, buy more stock. You continue to dollar cost average in. By the time you're ready to really benefit from that, you've got a nice pile there, and you don't care as much about the stock price because you're not planning on selling it. You're caring more about the dividend. That's yet another way. Another way is you can buy bonds. Bonds give you a legal obligation to get your money back. So bonds are managed by law. You buy a bond at $1,000, right? Mm-hmm. That's the cost of a bond. Some companies will issue that bond for $800, right? But at the end of the bond's maturity, you get $1,000 back, plus all the interest you made on that. That's called buying a bond at discount. You buy a bond less than par value, $1,000. So there's a guy that I know who bought a bond at $200. When it matured, he got $1,000 back for every bond he owns, plus all the interest he made along the way. You can make great money that way. And if that company goes under, the first people that company has to pay are the bondholders. They're first in line to get repaid. If you're a stock owner, you're last in line to get paid. So if a company goes under and you're an owner in the company as a stockholder, a shareholder, you're last in line to get paid. You're going to lose that money. So there's a lot that you can do. There's so many strategies. There's so many different things to think about. The best thing for a new person to do is to do some of their own research and possibly go to an investment manager who can invest that money for them. And of course, you would want to see a really good track record with that investment manager to make sure you're putting your money with someone who's really good. There are bad investment managers out there Or there are people who are really good for a time, make a bad call, and those things happen as well. You want to do your research. But are there ways to make money? Yes, there has to be. People are making it, right? Can you be one of those people? Yes, you can. Can you easily lose everything if you're not thinking about this in the right way? Absolutely.
Yes, you can.
Yeah. So I'm gonna be Abdul for a minute. I'm not gonna shit on the whole system, but
yeah.
but I am gonna shit on the strategies or lack of strategies that some people use. Having no strategy is the worst thing you could do. Getting lucky is even worse than being good, because if you're lucky and you make money, you think that luck's going to hold, so you do something lucky again without doing your research, and now you're really going to lose, right? So sometimes winning can be a loss in the long run just by being lucky. You want to be smart. Have an investment strategy. Let me take that back. Here's what I'm doing. I'm not giving advice. I always have an investment strategy. I can always tell you what that investment strategy is. If my investment strategy is off, I have the right and ability to change my investment strategy, right? So I'm in control of my investment life. That's what I do. But I take the time over time to learn, right? So I'm learning about a whole new thing right now that's involved with AI. I'm loving it. I'm absolutely loving it. Am I ready to go all in on it yet? No, I don't know enough. There's more I need to learn before I go forward with it. So I'm going to invest the time, an hour here, an hour there, weekends, whatever, because I enjoy it and have a passion for it. But I promise you, when I'm ready, I'm really going to be ready, because I'm not going to invest $1 until I'm confident that I know what I'm doing.
So I'm not an anti-capitalist, so I don't want to come off as an anti-capitalist. And I know a lot of the stuff because of you and because of stuff you say, hey, read this, and then I read this.
Yeah.
But if we go back to like 08,
yeah,
and taking the position of the working class, I knew what they were because of you, but the average person didn't know what a collateralized debt obligation was.
Right.
The average person didn't know what a mortgage-backed security was. The average person didn't know that there were these Bernie Madoff guys going through the system, scamming everybody.
Yeah.
So from the working class perspective, which is the position I'm taking for the purposes of this.
Can I make it even worse?
Yes.
And in addition to everything you said, people tend to make decisions based on memes.
Yes.
Real
That's
estate
the other part I forgot to mention.
down.
Marketing. This thing was mass marketed. This thing is a commercial that goes on and on and on. You have whole football arenas named after some of these places. So between all the ignorance, for pun intended, of the majority of the people, and then the mass marketing of this machine to get you to jump into this system.
Yeah.
Like, guys, again, how is this thing not rigged?
I can't say one way or the other. What I can say is I think people need to do their research, right? Like, for example, like I mentioned, I bank with a company that is designated as too big to fail. Because if we end up in another 2008, 2009, I already know what happened then with that company. Mm-hmm. Is it a guarantee that they'll be bailed out again? No. But do I have a stronger likelihood that they will be based on what I've seen and what I know? Yeah. So I'm decreasing my risk by banking with a company that I know is a good company, but I also know that if they were in trouble, there are other associations, the U.S. Treasury, the Federal Reserve, and others that have an interest in keeping them going, right? Now, could they absolutely make that decision and say, nope, we're not going to do it again? And have they been saying that since 2008, 2009? Absolutely. But when you're in the crisis, different decisions get made. People have to make decisions. Companies and these regulatory institutions make decisions all the time that they may not like, but they want to save the system. So, am I hedging my bets by doing this? Yeah. And did I go all in on this bank? No, because there's still a risk there too, right? So you want to think about, where can you sleep well at night? So back in 2002, I did some research. My house was worth double what I paid for it in just 5 years. I did some research, realized, wow, that's not normal. And I kind of think based on what I'm seeing here, we're in a bit of a housing bubble, right? Sold the house, sat on the gain and waited. Everyone told me I was crazy. How are you selling your house now? Housing never goes down. Right? You sold too early. Look, it's going up, it's going up, it's going up. James, you're losing money because you're not in housing. You should buy a house right now. No, thank you. I'll wait. I had a guy, and this was in 2007, someone I worked with. I begged him. He was going to buy this house. It was a shack in New Jersey for about $500,000. The house normally would be about $200,000. He was going to buy it as a fixer-up. I begged him, please don't buy this house. I honestly believe housing is going to go down as part of my investment thesis. He said, can you tell me the day it's going to go down? No, I can't tell you the day. But in terms of what I'm seeing as a trend, right, this is not sustainable. He said, if you can't tell me the day I'm buying the house. He bought the house. I'm the only person I told him not to buy the house. And I never do that. I never tell, I have respect for this guy. I went further than I should have and begged him, don't do this. He did it anyway. A year later, he comes over to me. Can I speak to you? Pull me to the side. He told me, he said, you're the only person who told me not to do this. That same house I bought for $505,000, I think the price was at that time, is now worth $350 and going down. And I can't sell it because no one's going to buy this house right now. Everyone's selling, no one's buying. At that same exact time, I'm in the market to buy because I've been waiting for this, right? I knew at some point it was going to go down. I couldn't wait. So it went all the way down. When I came to the house I'm in now, the homeowner said I was the first serious buyer in 2 years that he had seen. We bought this house in 2010. I'm in the house I plan to retire in. I'm never leaving. So I got this house for a song, right? Because I made a decision that wasn't popular. I didn't follow the crowd. I didn't listen to the memes, right? And I actively took shit from people who told me that I was wrong. Okay, then I'm wrong. It's my choice to be wrong. But I had an investment thesis, and I'm a better longer-term investor than shorter-term investor. So I was willing to wait 8 to 10 years for my investment thesis to come true. And now I've been in this house for 15 years. So I'm good. So
I like that sinister laugh, like, you lost your money, you idiot.
Look, I can't tell you how many times people told me I was wrong and things people have told me I was wrong so much, I stopped telling people what I plan to do. If you ask me today what my plans are, I will not tell you. I won't tell anyone because I'd rather just sit here quiet and do what I'm going to do and not deal with the shit that comes with people being emotional about their investments. I'm not emotional about my investments. I know that I'm either going to be right or I'm going to be wrong. And I have to make a decision either way. And I can't predict the future. So I do the best I can with what I've got. I've had some nice winners. I've had some losers. I make sure I cut my losses when I'm losing and I ride my winners.
Wow.
Speaking about riding winnings, Kristen, do you have any questions before we get to the lesson?
No, James was really clear about a lot of things. I can't regurgitate any of it, but I got it. It's in there.
It's like Progresso.
I gotta do my Soul Train scramble board on my own time.
Water hose, meat teacup.
It was really interesting, though. It was really interesting. So, and I know that you asked him, how is it not rigged? He can't say it's not rigged, which to me says it's probably rigged. But
I can't say it's rigged, and I can't say it's not.
You can't say
rigged.
either way, right?
Yeah.
You can't say
this is not a car that I'm about to sell you.
you to drive away in, right?
Yeah.
But what I can say is that you have to understand your risks with every investment you take.
I do believe we can make money off of it because we may not get in the in that small circle at the top, but we can still catch some drippings or something like that. But yeah, I never could figure that stuff out.
And it's purposely difficult, right? This whole industry has terms. It has, why do we say margin instead of insurance? Why do we say call instead of, all these other terms, right? We have all these terms for these things.
Buy a bear and a bull.
Yeah. We have, and it's true that every industry has their jargon, and this industry is no different, right? Investments are no different. But take the time, if you're going to play in this industry, and you're playing whether you want to or not, you just are. You're in this industry whether you want to be or not. So you might as well learn about it. So take the time to, I remember back in the late 90s, I just Googled at the time, I don't know if it was Google or whatever, it might have been AOL, but I remember searching for what is money. I just started with something that I thought I knew. What is money? I was shocked to realize I didn't know what money was. And that's kind of what started my research path. Like, wow, something as simple as what is money, you would expect an answer that you would understand. And then you realize there's a difference between money and currency. And we print money, and money has no intrinsic value, and it's borrowed into existence by the Federal Reserve and the US government, and insurance companies can create more money through loans. Like, I went, wait, what? That's another topic for another day, right?
That's a whole
but
show.
That all came from what is money? So I just took each term and that I thought I knew, and researched it, and then realized how much I really didn't know.
In my head, I was thinking that song, What is Love? And the rest of the line goes, Baby, don't hurt me no more. It's like, what is money? Baby, don't hurt me no more. It's pretty much the same thing. But
Yeah.
all right, so let's go with the lessons, James.
Pretty much the same thing.
It is, what is love? What is money? Baby, don't hurt me no more. It's literally the capitalist manifesto.
Oh yeah, oh yeah. You'll notice I don't even call it money. I call it currency.
Currency,
Yeah. So I have a different definition of money. I challenge everyone that's listening to go look up what is money versus what is currency, and have fun, because your brain's about to explode. Life lessons. Let's really talk about this. So ask yourself. You've heard me say this multiple times. Ask yourself if you're an investor or a trader. That's important. Are you a person that does better with a long-term thesis and a plan for how you're going to make money, or are you a person that does better shorter term? Notice I said, are you a person that does better in one or the other, not which way do you want to make money? Everyone wants to make money now. Not everyone can. I am a better longer term investor than I am a shorter term trader. I just am. That's over time, I've learned that. So I go with what I do best. I'm better thinking longer term. So consider where you're better and then play in that area, whatever that is. Do your due diligence. Due diligence is required for any investment. And when I say due diligence, you have to understand why you think it's going to make money and understand how it can lose money. You have to understand your risks before you start. And are there ways that I can mitigate that risk? Like a stop loss, like saying, if I buy at this price and it drops by 20%, that's my stop. I'm going to sell at that point. And then be disciplined about your mitigation strategies. Don't let well, I'm gonna hold on to it a little bit longer because I heard some news and I think, no, if I hit my stop loss, I hit it. I'm out. I don't care what the media says, right? I am that disciplined. And if I hit my gain, if I have an exit strategy that says when I hit this price, I'm out, regardless of the news, regardless of what it looks like, I'm out, because that's my investment strategy. So do your due diligence, have a plan for if things don't go the way you want them to go, and stick to your plan. No matter what, stick with your plan. If you hit, at least in my opinion, at least the way I do it, if I hit my target, I'm out. Understand the risk before you invest. We already kind of touched on that. And don't follow the herd. It's the worst thing you can do. There's a saying that says, when you follow the herd, you're bound to step in shit. So don't follow the herd. Be your own trailblazer, right? Figure out how you're going to, what are you going to do to manage your investment life? And if you go with an investment manager, professional manager, make sure you understand what their investment strategies are and make sure you agree with them.
So, Kristen, what have you learned?
I have learned that I need to be smart and listen to smart people. So I'll be in touch, James. do what James says. I've learned that. I've learned that I still don't know a whole lot about all of that stuff. Or as a matter of fact, I learned that there's even more that I don't know. Thanks a lot, James. Thanks a lot. Thank you so much. Because like I said, I've invested in a couple of things here and there, but I probably would have been guilty of being that herd one. But it's like I have little characteristics of all the positive things that you said. I have like a little bit. I don't do my full due diligence, but I do a little bit. I don't necessarily follow emotion. I follow like what makes sense a little bit. And when it comes to like, why would this make sense? I think about, and I know I've heard people say like, well, you should invest in whatever you would use. And it's like some of the stuff that I use, I don't even know if I should be using it, but I'm like, I don't know about all that. I don't know if that's the method I want to take. But I'll think about, is this something I could see everybody, something like you mentioned AI, we're going down that road. So now, which AI road would I be interested in going down? Because we're not even going down it. We're on that road. We're on on that road. Yeah. And like, I remember I was at a party, a Christmas gathering, and everybody's talking about stocks and everything. And my son is very quiet and low key, a little college student at the time. And somehow somebody said, Ari, what would you invest in? And the room got quiet and he goes, military equipment. And everyone just was like, wow. And I'm sitting here like, wait, what? that makes sense. And it shocked me because I didn't expect him to think about stuff like that. I didn't expect him to have that answer, but it made so much sense. That's not something I'm into. I don't like guns. I don't like anything that promotes death or anything like that. But at the same time, you're getting in this to make money. And I mean, everybody's making and selling military equipment. So, but one of the things that I started in was the real estate investments, where not quite real estate, but I forgot what it's called. It has a phrase, it has the acronyms, where I get money from their renters. So I definitely see a consistent dividend. And I'm like,
landlord.
Okay, no. No, it is a specific name for it. I should know. This is the part where I'm really slack and I'm just like, I don't get it. I don't know, but I do know. And I'm seeing consistent dividends as a result of that particular real estate. So I like that a lot.
No, you make a great point. You made two really great points. We all probably have more to learn than we think we know, right? So I am no expert. I'm not. But I know enough to know that I need to continue to research. So I just continue to learn slowly over time. So I love what you said there, that for all of us, unless you're an investment professional who does this for clients day in and day out, you're probably not, there's probably more to learn. And remember, even those guys lose money, right? So you got to really think about it. The other thing I like about what you said is there's other industries. You don't just have to invest in the stock market. The bond market is actually larger than the stock market. A lot of people don't know that. You mentioned real estate. You don't just have to buy real estate, fix it and flip it. You can get involved in owning mortgages. You can get involved in buying tax lien certificates or tax deeds. There's so many avenues.
But this thing is I did it through my E-Trade, I think it was, but it's like a stock.
It's called a REIT, ERIT. So you're right, trades like a stock, but it does have specific rules and it pays out most of their profit. So those are REITs, REIT.
Yeah, that's what I meant to share with everybody. That's what I'm talking about, that right there. I recommend that because you will see consistent dividends on that. Now it's going to take about 100 years to get $5, but I mean, you're not losing.
You're not losing. But to your point, there's so many ways to invest. You can invest in your own business, invest in yourself, invest in your own business. And there's so many different ways to create businesses where they don't have to be physical. You can create e-businesses, right? There's so many ways. Figure out what you want to do and where you want to put your interest. Figure out how it can be profitable. Find the people who are profitable in that space and learn how they did it. Move forward.
All right. I guess my lesson is caveat emptor, buyer beware. I always think that understand where you're at and the game that's being played around you. We are in a capitalist system. There are reasons why things move and shake the way they do. Madison Avenue has so many ad agencies that they're used to market and push certain agendas and ideas and things your way to get your money. A lot of the times, it looks like the system is devised to cipher the money from the working class up until this small circle of people. So if you're going to participate in any of this system in capitalism, buyer beware. Know what you're buying, know the reason why you're buying this stuff, buying, not just physically buying, but buying into. Why do you believe these ideologies that they have? Why do you believe in the system that you're working in? Why do you believe in investing your money in these particular places? Buyer beware. Beware of whatever you're investing your time, energy, and money into, because there's a guy rubbing his hands together on the other side of this thing, looking to take whatever it is that you're willing to give. With that being said, this has been another episode of Ignorance is Contagious podcast. Please like, share, and subscribe. Until next time, see you later.
Thank you.
Shout out.
The Rock is in the building. Facto.